Welcome back to Markets Today. I'm your host, Mbitha Mwema. We are discussing last week's performance of financial markets with a key focus on the Nairobi Securities Exchange, as well as touching on government treasury bonds and yields. What do we expect to happen this week, and what do we expect, more importantly, for the remainder of the final quarter of the year 2020? Joining us in studio is Mr. Reginald Kazuttu, who is an economist, taking us through the synopsis of last week and what to expect. Welcome back, Reginald. Just before we took the break, we were looking at the telcos at Safaricom, saying that for the next 2 weeks before the financials might not be a good time to buy. If the price actually edges upwards, there could be an opportunity to take profit. Then the second thing we have discussed is the banking sector, saying that there are many moving parts. So in as much as they could look cheap on valuation, you probably want to look at their valuations based on forward-looking numbers and wait for third quarter to get a better sense of what's going on. So it's also a bit of a hold in that particular sector. Let's look at manufacturing sector. East African breweries came down to 157 in the last week. What's your sense of this? And also in light of the fact that the COVID situation, the numbers that are trickling through in Kenya are increasing. Do you see a possibility of another closure to the economy? What does this mean? What's the read-through for a company such as EABL?
Whether we're going to close down, I think that is debatable. I think the government is clearly trying to go the route of herd immunity now, as in let's just live with it.
Okay.
I'll be shocked if he does do more restrictions or revert back to the old restrictions. The question that is coming to place is, have people gone back to their usual lifestyles? Are bars full to the rim? Because EABL makes money as people are drinking, ideally partying and doing the things that they normally used to do. The question is, are people doing it every day like they used to do, or are people now just only drinking on Fridays, Saturdays, and all? So that as long as the restrictions don't come back, then EABL are still a very good stock to buy.
Okay.
In terms of potential of recovering. If there is a stock that can have a V-shaped recovery, it will actually be EABL.
Okay.
And if the next budget cycle comes and there are no, again, surprise tax measures, unfortunately they normally hit by all those other funny things. And these guys have adjusted excess duty by inflation, thinking, okay, that doesn't make sense at this point in time. But ideally they should recover faster.
Okay.
So buying it at those prices is reasonable and cheap enough, and it's a stock that I would actually expect to see a bit more activity in, especially with the opening up of the economy.
Okay.
And the issue that then becomes is, again, I wish we had Q3 numbers.
Yes.
Because it shows how activity has increased.
All right.
Which will give a positive sentiment for anyone who wants to enter into EABL, because activity is actually increasing.
Okay.
Because then you don't want to fool yourself by, I drove through 1, 2, 3 bars, they were full, so I think everywhere else is full. Then you might realize that is not actually the case. So if we get some data on activity between June and September, or June and now, then we can have a bit of a focus to actually see where EABL is headed. And
also use this as a proxy. At times, if you're either driving through Thika Road, or if you know people who live there, there's normally an occurrence once in a while during the year where you see an influx of trucks coming to collect alcohol from EABL. So maybe that could be a trigger next time anybody's driving through Thika Road, like, are there trucks, extra trucks there?
That's an interesting way of doing it. But yet,
yes, because I mean, like in December last year, the number of trucks that were piled up outside East African breweries are numerous, especially as we're getting into the festive season. So there were many. So you can't really have a clear sense of how many trucks go in or out. But I normally look at it like, if you're able to know or glance and see that people are lining up, it means that there's demand for that. And in the same vein, also for their plant outside of Nairobi. So if there's demand for it, then that could be an indicator, but it's not a clear indicator to be able to capture on a regular basis. But let me ask that question differently. So 157 means it's trading at a trailing price to earnings ratio of 17.7 times. What is a good ratio to get into EABL? Can it get cheaper? In your experience as a portfolio manager, been in the market, have you seen EABL trade at a cheaper level, so that we're not necessarily focusing on price, we're also trying to extrapolate its future valuation points?
It definitely has traded at cheaper multiples than that. But if you then look at it as a foreign investor, and that's something that people need to understand, that a foreign investor does not look at just the Kenyan market. So when they look at the multiples for EABL, they are looking at it compared to Delta in Zimbabwe, Castle in South Africa, whatever.
Guinness, Nigeria.
Guinness, yeah, exactly.
Okay.
So they're looking at those and wondering who is cheaper and who has a better chance of growing faster.
Okay.
Then you look at the Nigerian and South African market. I think they drink more than Kenyans, and they have a larger population. So that means the market for their beers are bigger, and definitely their revenues also bigger. So can it get cheaper? I don't. I think we have passed that stage.
Okay.
In terms of what could have made it cheaper during this period, unless they give us shock results.
And that's a bit of a far way along, because they report end of December, sometime in February. So between now and February, we don't have any visibility of
on what's happening. So I'll say it's the only thing that will be downside for them is if restrictions are put back, or if they give us shock results in December, February, and restrictions being put back. I think until the death rates, the number of deaths starts increasing, then we might see restrictions coming back. But the number of positive cases, I don't think we're going to see that getting restrictions. So the downside risks are not that many for EABL right now. And it might be you might not make money between now and December, but definitely when the results start coming in and things start normalizing, it will be a good stock to enter at such prices.
So especially focusing at the tail end of the year, because December there's normally another softening. So this softening for the final quarter has actually started in the month of October. But typically these volumes, we normally see them towards the end of November, getting into December, because we think we've been trading for this week about 200 million, 250. It's only once that we jumped to the 500 mark or slightly above. So I guess it will be interesting to see how liquidity pans out on that. What about British America Tobacco? Because BAT and EABL, when foreigners are looking at it, rightfully, as you have said, they do look at valuation, but they also look at the potential of a higher dividend yield. What's the outlook for this other company?
I haven't really looked at the results for BAT of late, but generally I don't think BAT was affected that much.
Okay.
Most of the effect might have been logistical, in terms of getting their tobacco and stuff like that, but in terms of processing the cigarettes and distribution locally,
it's easier to get a smoke.
Yeah, so
than it is.
If they blame anything on COVID, they're just lying. As in, they'll be completely lying.
Yes.
Yes, and just unless maybe just supply of tobacco, might be only been the logistical item that would have come in, which means reduced production. But when something is reduced, that means prices go up.
Okay.
So which normally compensates for reduced production. So yeah, but for big investors, yes, you can buy into BAT. Retail investors, stock price is just
stock
too
price
much.
it's a bit of a higher price. Okay, fair enough. Now let's just look at the top losers for last week and just get a sense of the direction this week. It was largely the small caps that were dominating activity. Olympia was down. Just not too much activity in terms of volume, but it was really slight price movements that we saw downwards. What's your take of this small caps, especially when you bring out the element of retail investors? Why do retail investors look for the cheap stocks on an absolute price basis, yet there could be more value in the slightly more expensive stocks, because they're always looking for the penny stocks? Is there a value? How should you look at this, at least as we go to the end of the year?
One, there's a psychological element. I'd rather be saying I have 3,000 shares off,
yes,
than I have 100 shares of BAT.
Okay.
So there's a psychological element of, I feel like I have something if I'm holding thousands of that thing. Penny stocks are good if you are an active trader.
Okay.
Because a 0.5% gain in a penny stock might actually be a 10% gain. Yeah. So it is easier for KQ to move to 3.5 or 3.6
then
or
it
4
is, okay.
And moving to 4, that's already 20% gain, and 20% is 20%. Whether you make it on BAT, Safaricom, or Kenya Airways, or Mumias, or Unga, it's still 20%. 20%. So there's also that psychological impact of thinking, I think this stock moving by 0.5 is easier than BAT moving by 33 shillings or 40 shillings,
Okay.
so to speak. So retail investors go for that mainly because of those two reasons. If they were then active and many, then you'll realize you can actually make a lot of money for penny stocks, because there'll be a lot of demand and there'll be a lot of volatility that is there. But the problem that we also have is our retail investors buy, park, forget.
Yes.
Remember after 6 years old, I know
What
I had
happened
shares.
and you missed out on
You
the...
know, and they come and start looking, I had some share certificates, I had, and things like that. So for institutional investors, if you're going into penny, it's literally you have heard some news.
Okay.
And you know that I can make a quick 20-30% and get out.
All right, fair enough.
Even with the trading costs
Okay.
in mind.
All right, so it just seems like there's nothing much happening there, because our top gainers, we did have Standard Group last week, Flame Trio, Meme, Home Africa. Then on the flip side, the losers, we had Olympia, Veredi, Sanlam. So it's pretty much the penny stocks, but not too much, movements that would have made you considerably richer, so to speak. But there is an interesting movement on Standard Group. It was up 20.7%. We did see a bit of oscillation on Nation Media about 1.5 months ago, where it went all the way down to 13, and then it started picking up. It built up momentum till 20, and then it lost ground, settled at about 18.5. Could this be a similar trajectory that could happen to Standard Group, or is it possibly a one-off because the volumes were pretty thin over the week?
I think when you look at the media stocks, especially Standard and the Nation, is kind of to think of what do you want to value? What do you want to, how do they generate the revenue?
Okay.
And most of it is from print. And you're thinking with COVID and all, how many newspapers were sold? So I definitely think that their revenue should have been hit. But now with BBI coming, you'll expect a lot of adverts from the government in the main two newspapers. Reporting season coming, a lot of companies posting their results, and they might be cheap to buy now, considering as we're getting closer to 2022. That's when they reap during elections.
Okay.
Campaigns, all these things, IEBC, government, and all that. So yeah, you might see a bit of volatility now, but again, when volumes are thin, you cannot predict direction.
All right.
It might be just someone decided to sell at whatever price because there's a shamba that they decided they need to go buy.
Okay.
Yeah.
All right. And I think that the final one, before now we move to other markets, Centum, we did see a bit of activity there, a bit of fairness on the buy and sell side. Then the price weakness, it touched a low of 18 shillings per share last week. And the argument that we keep hearing, at least from investors, largely the retail investors, is there is a deep discount to its book value. Now, normally, investment companies normally trade at a discount one way or the other, whether they're listed here, whether they're listed in Europe or mostly South Africa, which tends to be the benchmark. But this particular discount for Centum is about 60% discount. It's trading at 0.4 times book. Is there something that the market is missing out on? Is there a need to pay attention to it? Because 18 shillings, does it get cheaper? Is there something that the market is just mispricing completely?
I think Centum became big and complicated, where you're not quite sure what do they actually invest in, what businesses are they in. It's different from the Centum of old, where you knew they have shares in Coca-Cola bottlers. You could list down the counters they are in, and you could also list down the percentage they had in the NSE. So it became easier. You could evaluate the direction that they will go depending on intake of sodas, the direction of the market. You will know that these guys are going to make a profit. But now when they went into retail, residential, coal, banking, it becomes a whole load of financial analysis that you need to do for you to come up with and say, this is actually their proper book value.
Yes.
And this is the potential that we see them getting. So when you get into real estate, there's a lag. So you're thinking, okay, when are you going to finish this development? It's going to take you 2-3 years. Is there value during those 2-3 years? There'll be no value. Yes, there might be value then. So you'll find their price will always play catch up to their book value. Is when, for example, if their Vipingo becomes very successful,
yes,
then people say, these guys are making money, you send the price that's
That's to
chasing
pick up. So we
after.
need it's highly dependent on positive material and positive news
Coming in.
trickling through. Otherwise, sell if any material news comes out, unless you're very sure that there could be any positive news that comes out in
Exactly.
the next 1 to 2 years. Then you could probably be hanging out on a stock that could depress further.
Yeah, exactly. So as the more complex they become,
Yes.
there's no insight. And if there's no insight as an investor, you're thinking, I don't understand this company. You'd rather just stay away.
Okay.
But if it was not complex and they could break down what they're doing and people see, oh, this is the direction they're going, then you can project value and say, okay, so this is the value that is there. And then you can now say, is it cheap or is it expensive?
All right.
But when you are shrouded in a cloud of, we're not quite sure whether these things they're doing is going to be successful. Two Rivers was not that successful for them. You're thinking, are they now headed the wrong direction in terms of moving away from their core competencies and strengths to start doing
Other
things?
things. Okay.
Now they own NABO, they own CDN, is now called, it's called CDN actually, it was KREP. They own a bank, bank is not doing that well. NABO is also not doing that extremely well.
Okay.
In terms of, it has not grown, I think, the way they expected it to grow exponentially. The way your Cytons or Corp Trust, Unit Trust did.
All right.
So there's that element of your thinking, are their projects backfiring? So you rather take a wait and see and say, I'm not Warren Buffett. I don't have billions to say I'll park 1 billion here,
and then I'm
forget,
okay for
then
that.
wait for the next 15 years. Most of the investors that we have, if it's pension funds or insurance, there's demand for return this year.
Okay.
If you're retail, we know our retail investors want to make, our retail investors were introduced to the stock market through IPOs. And the orientation of investing is you buy now, you make 40-60% gain in 2-3 months.
Yes.
Until we change that orientation to know that you can buy and hold something for 5-6 years, then our retail investors are just speculators, so to speak. Yeah.
And the final question on Centum, and then I can briefly move into the treasury bills. 1.2 shillings, that's the dividend that they paid out in the last financial year. Can they sustain this? Because beyond just trying to understand the underlying assets, another way of looking at it is asking yourself as a shareholder, then my output out of this company is 1.2 shillings. In your perspective and your overall view of Centum, do you think that based on the shareholding structure, they could sustain 1.2 for another 2-3 years?
They can be able to, depending on how they grow in terms of revenue, but they can be able to sustain 1.2.
Okay.
But I don't view Centum as a dividend stock.
Yes.
They are more of a growth. They actually should be considered a growth stock.
Yes.
Ideally, you're looking at exponential capital gains as going forward. A dividend, I think, is just to appease the big
Okay,
the big
fair
shareholders.
enough. Yes.
So there are some stocks and companies that you enter, and your mindset should not even be on dividend. Dividend would be a bonus.
It's a bonus, and it's
Yeah.
interesting because, like, based on the last paid out dividend and the current price, it's yielding a return of 6.6%. But then now, when you flip over and look at the treasury bills, the 1 year is giving you 7.8%. So there's probably more value in other opportunities out there as opposed to parking and just looking for a lower price point. Let's briefly look at what happened last week on the 91-day, 182-day, 364 treasury bill. We did actually see lower demand, largely because the previous week there was a fixed coupon paper, 2 issuances that had sapped up liquidity from the market. Every week the government issues 24 billion in terms of treasury bills. Last week it only attracted and selected bids valued at 19 billion. The 1 year was at 7.8%. That's the 364-day. The 182-day was 6.9%. And then the 91-day was 6.58%. What's the outlook on these rates? Could they go up? Because 7.8 for the 1 year, 182 giving you an annualized return of 6.9, it does sound pretty low. Yet on the flip side, the fund managers are giving you a return of between 8.5% to 9%. So how do you balance this out in terms of you looking for a return and looking for a safe haven of putting your money?
The returns are low because there is excess liquidity in the market. If you look at the interbank rate, which generally will measure for you liquidity, it's not above 3%.
Yes.
So it's low. So a bank getting 7% is way better than what they will get if they do anything else.
Yes.
Because they are not lending out. Ideally, a bank makes more money when they actually lend out than buy treasuries. But the rate is edging up because also banks are looking for a bit more. About 7% will not be enough to cover their cost and generate money. So you find they are bidding a bit more competitive to try and push the rates slightly up and get that extra basis point,
Okay.
1 or 2 and the like. Yeah, if I'm an individual investor, I'm better off getting money from a unit trust, which gives me 9-10%. I've got no business investing in treasury bills because it does not make sense. To earn 6-point-something%, inflation is at 4-point-something%. In essence, you've earned 2%. If you hit you with withholding tax on interest, you've made 1%. So you are better off definitely in a unit trust or a money market fund or whatever that is giving you between 8 and 10%.
And is this return from the money market, is there a tax element or is that the net return that you get?
Okay, it depends on who is. Ideally, ethically, everyone's supposed to publish their net returns.
Okay.
But you'll realize most people, by the time they're telling you 8.5, that's net of withholding tax, because that's the only tax that is there.
Okay.
Withholding tax on interest, which is 10%. So in terms of tax effectiveness, they're also cheaper in terms of tax on, and it's a final tax. So you don't need to go and file it when you're filing your returns going forward. Are the rates going to go up significantly between now and December? I don't think so. They might edge up inch by inch the way they are doing now because the government has to continue borrowing. Deficit continues increasing because Korea are not meeting their targets. That means they have to borrow more domestically.
Okay.
So they're not about to slow down
on
the borrowing.
So let the banks lend to the government, then for you as a retail investor, give your money to the money market funds and get a slightly higher return.
Yeah.
Okay.
And the money market funds still take that same money to the bank. The bank
Yes.
still takes it to the... It all ends up with the government.
It gets up with the government, but you'd rather get a higher return.
Yeah, as an
okay,
individual, get a higher
fantastic.
return.
So it sounds like we've talked about the NSC and we've talked about fixed interest returns. And from this conversation, it just sounds like NSC, because we've really racked our brains trying to see, is it a good time? What's a good stock? But then it's very clear when it comes to the fixed interest returns that you're going to get between 8 and 10%, and you'd rather go for that.
Mm-hmm.
Now, we are at the tail end of the year. What would you tell investors who are watching today in terms of what should they think about for this week and also the remainder of the year in terms of investments in the financial markets?
I think I'll go back to, and for fear of sounding like a stuck record, your investment should be driven by the goals you want to achieve.
Okay.
And the goal you want to achieve will determine whether equities will make sense or money market will make sense because of the power of compounding. Mm-hmm. The only problem of equities compounding is manual. You have to sell and reinvest. Money market compounding is inbuilt, it's automatic. Especially for money market funds, it compounds for you. Which may be a better way, especially if you're a new investor starting.
So just go put your money there. Just
put in a money market fund. You have to keep in mind the element of opportunity cost, which most people don't consider when they're making an investment decision, is that I would rather be earning the 8%, 9% as I wait for the right time to enter into a stock.
Okay.
But to say, no, the stock will go up, Safaricom right now is cheap, it's a monopoly. Yes, it took them 8-9 years to move from 2 shillings 50 cents to 20 something.
30, yes,
yeah?
30.95.
Exactly. Yeah, the return was good, but you could have made some other money. You could have compounded, sold, rebought, sold. So there are a lot of mechanics that come in, and it's not as straightforward as people just think it's enter into equities. But the whole purpose of money is to achieve what you want to do in life.
Fair enough.
So if I want to buy a car, buying a banking stock right now, you're going to buy that car in 5 years' time because you're not going to get much return going forward. Yeah.
Okay, so then thank you so much for your time. That was Reginald, and what he's telling us that it's not really a one-on-one saying I should buy stocks or I should buy government treasuries or I should put money market funds. What's more important is to take this time, pick up a pen and paper, use your phone or your laptop to actually define what are my medium-term goals and then what instrument helps me to arrive there as opposed to deciding where will I make money. That's all the time that we had today. We hope to see you once again tomorrow, same time on Markets Today. Good afternoon.